Thank you everyone for joining in another round of our masterclass. This masterclass is almost like uh, I would say from last 5 years, every month we keep doing this masterclass. So idea is to bring investment insights which investors are not aware of, and I feel today we are going to have a very interesting round of that only. So let me give you a context why we are doing this. One second. The echo. Yeah. So, life at its core is quite simple, and so is investing done right. Yes, yet we often find ourselves chasing the next big thing, much like 238 new fund offers launched in mutual funds last year. That's almost like one NFO next every working day, and there is a raise of almost 1 lakh crore happened in this space. Most of these were thematic, chasing trends, sectors, and market flavors of the moment. But as we have seen time and again, market correct sectors fall out of favor, and yesterday's winners become tomorrow's underperformers. So investing often feel like a maze, especially in a country like India, where retirement planning has rarely been a focus. If I think about my father has never thought about retirement planning. While countries like US have their 401k plans as a cornerstone of their retirement savings, India has its own powerful answers. I would say national pension scheme, which today's session is about uncovering that often overlooked gem, particularly for HNI investor. Because as I'm talk, most of our clients are HNIs, and who talks tax, who seek tax efficiency, long-term growth, and simplicity in their financial journey. So, Mr. Iyer, maybe first I should give a introduction of our today's speaker, and we are really privileged to have Mr. Sriram Iyer, who has accepted our offer to have been be a speaker of this masterclass. He's CEO of HDFC Pension Management Company Limited, and brings in almost 30 years of leadership experience across banking, capital markets, financial product distribution. Under his leadership, HDFC Pension has become the largest private sector pension fund manager, managing an AUM of 1.1 lakh crores and serving almost 22 lakh Indians. Recognized as one of the top 20 pension executive in Asia by Asia Investor magazine in 2023, Mr. Iyer's passion for financial literacy is evident through his numerous article, media appearances, and investor awareness session. So let's explore how NPS can serve as a reliable pillar for retirement planning, especially for HNIs who often juggle complex portfolio. This session isn't about tax saving; it's about building a future that's financially secure, uncomplicated, and tailored to your long-term goals. So I think before we kickstart this session, there is a small poll which we want to run now. And Mr. Iyer, our idea is to give you some background, what our investors know and what they don't know, right? So maybe you can tailor the discussion around that, right?
Sure.
So request everyone to quickly take a poll, which must be there on your screen. We'll wait for a minute before you complete this poll. Request everyone to take this poll. I know it's a little lengthy poll. We have some 30-40% people already done this. We'll just wait for 20 seconds more. Great. So I'm just ending the poll now. Yes. So I'm just sharing the results in front of everyone. So as Mr. Iyer, I think this will be thoughtful for you, at least a lot of observation. Are you currently investing in NPS? I think 41% are contributing regularly and 47% are considering it. What is your primary reason for considering NPS, retirement benefit and tax benefit? Uh, do you think NPS is a better long-term wealth creation option compared to traditional retirement thing like PPF, EPF? Uh, 47% feel yes and 47 not sure. They want to understand this. How do you plan to use NPS corpus for retirement? Withdraw the allowed lump sum and invest elsewhere? And how familiar are you with the tax benefit of NPS? 60% know a little but need more clarity. I think that will be something, Mr. Iyer, if you can give us some insights on. Uh, and if you are investing in NPS, what is the main reason? And 45% feel lack of awareness about how it works and uncertainty about returns and withdrawal. So I think there are a lot of questions, and that is the precise reason why we thought we should have a session with you, so that we can get a lot of insights around it. So, Mr. Iyer, I leave the floor all for you. Thank you very much. Yeah.
Excellent. Thank you so much. Is my screen visible now, Tarun?
Yes, I can see that.
Excellent. So, thank you so much for this very generous introduction and also for the very, very incisive poll. I think it's always good to sort of get a sense of what the audience is thinking before you get into a presentation such as this. And I am fully cognizant of the fact that, the kind of clients that you serve, these are all fairly seasoned investors. And hopefully, by the end of today's session, I'm hoping that this is time well spent for them and they're able to, know something slightly more about this fantastic vehicle, which I often refer to as a silver bullet. Um, you know, in my conversations with investors as well as with corporates that we work with. So that's my intent. But I want to give you a little bit of a context. And I think you touched upon a very important subject right at the beginning, which was around the importance of retirement planning and where we are headed as a country. And I want to just lay the context for that. While Indians, and I think all these numbers are very well known to you, um, all of these things pretty much tell you that um, Indians are no longer what we used to be maybe 10, 15, 20 years back. I think in every single financial product, there is a fair bit of awareness, there is a fair bit of acceptance. Is it enough? Obviously, no. But I think from the time that I started my career way back in the early 90s to where we are today, we've come a long way. Be it stocks, be it mutual funds, be it SIPs, we all know the story. So Indians have really rapidly financialized. No longer are we in love with, of course, we continue to be in love with real estate. We continue to be in love with gold. It served us well. It served us well at some points of time, possibly disappointed us in other points of time. But by and large, I think this whole financialization of savings is something that has started and is on the right path. We are still a long way to go, but I think this has certainly happened. However, if you look at financial planning, and I'm sure Tarun and his team do an absolutely fantastic job, we are still not in it when it comes to financial planning, right? Financial planning architecture in India is still, I think, very thin. I think individuals like Tarun and his firm obviously are putting in a lot of effort, and I have the good fortune of knowing a number of financial advisors and distributors as well in the industry. They do a phenomenal job, but I think at the end of the day, Indians continue to as Indians, we continue to look at product solutions rather than a holistic solution, right? And that's a big issue, not just in India, globally, but I think more so here. So if you look at the number of RIAs, if you look at the number of CFPs, if you look at the number of people who know what is there in their investment, and I've actually been, involved in the wealth management space as well at some point of time in the past. More often than not, there is this, as Tarun pointed out right at the beginning, we are constantly chasing the next new thing, the next new vehicle, the next new exciting opportunity. Very rarely, I've asked this question to a number of HNI investors, and I haven't got a very clear answer. What is the CAGR on their investment portfolio since inception? Very rarely do I get a correct answer. So I think while financialization of savings has happened, we continue to use products as products and not for a larger goal. But I do hope that this changes, this will change with the efforts of people like Tarun and his community. This will change because the important thing is to first define your goalpost, and then everything else is a means to that end. And hopefully, slowly but surely that will change. But I think a lot of time is spent today by a majority of Indians on just products, right? And that has to change. When it comes to retirement, I think this cartoon is very topical, right? I mean, uh, while I think we are busy doing various things at the during our lifetime, it so happens in many cases that when you actually have to sort of retire into your golden years, uh, you're either not very clear about what the path ahead is. A number of people, and I'm sure this cohort here or this audience here is much better informed, much better guided by people like Tarun. But I think in general, and this is more a commentary on, let's say, the 80% of the Indians that don't do enough of thinking around financial planning, or they don't have the wherewithal, or they don't have the resources to do it. And there is this huge challenge that I see individuals faced with, especially the number of retired corporate executives that I have the good fortune of meeting from time to time. Very senior level folks, executive director, director level folks from large private sector and public sector undertakings. At the time of retirement, they are reasonably at sea, right? I mean, their ability to really comprehend, how to sort of deal with the unfolding reality of their golden years is not very clear. In fact, a number of them at the age of 50, 52, 53 will start saying, okay, what do I now need to do for retirement? By which time it is possibly way too late. So this is really the reality with a large segment of the Indian population. Not so much, I'm sure this group is of course much better informed, I'm sure. But I think in the context of retirement, I think, and I think Tarun spoke about this right in the beginning. While we are an incredibly young country, our median age is at this point of time 29, which means that close to 70 crore Indians are below the age of 29. But keep in mind that 1 in 10 Indians today are above the age of 60. That is likely to go to 1 in 5 in the next 25, 30 years. By 2050, it is estimated that there will be 32 crore Indians above the age of 60, which means that we have to prepare ourselves for this impending change in demographics. While we at this point of time are very well placed, but I think as time progresses, India will age. In fact, our fertility rate, which is the replacement, which is essentially the number of children that are women of childbearing age, is bearing. Right now, the number is 2.1, and below 2 is what is called as maintenance rate, by which I mean that very shortly India will be in a situation where the population will plateau and in fact will start coming down, which means that the extent of the severity of the problem of old age population and the overall population is going to only get accelerated. Uh, Life expectancy is improving. Families are getting more nuclear. I mean, if you look at the number of people that used to live in one family unit, it used to be close to 5. It's now lesser than 4, which means that family sizes are getting smaller. The traditional approach of saying, okay, my children are going to take care of me is gone, right? So essentially, and of course, from a retirement preparedness perspective as well, and there are various studies that happen at all points of time. I mean, there was a Mercer study that happened recently. I think last year, India was ranked 47 out of 48 countries in terms of retirement preparedness, right? So I think, and of course, there are various other statistics which I don't want to bore you with. But the point I'm making is that this whole shift of demographics in India is going to be meaningfully large, and I think we need to be prepared. And each one of us is going to be impacted in different ways depending upon how how well we are prepared to deal with this change that is likely to happen. It is a priority, um, but these are some of the questions that most people deal with. In fact, NPS, which which is what Tarun, as Tarun pointed out, I run the NPS business for the pension fund business for HDFC, and being a fairly large scale player both in fund management and in the distribution business, we see a lot of these things play out during our interactions with individuals. After all these years, so NPS is a product has been around for the last 15 years for a private citizen. For government employees, it's been around for 20 years. But there are only 62 lakh Indians, non-government employees, who have adopted NPS, which means that NPS is a product. It's got a long, long way to go in terms of adoption. At this point of time, and that's one of the, and I readily agreed when, Tarun reached out to me. I said, more than happy to talk to your investors, your customers. Every opportunity that I get to sort of talk about this product, I don't miss. Hopefully, at the end of this, I'll have a few more people convert to NPS. And if you're already not a part of this, or if you're already part of this, I hope you're able to take this a little more seriously and then invest a little more meaningfully as far as NPS is concerned. Uh, now, now, this is broadly how the structure is, and I don't want to really spend too much of time, but I want to lay the context on what NPS is. Essentially, it's a product which is being developed by the government of India. So it's of course something that was created in the year 2004. If I were to go back in history, government employees in India used to get what was called as a defined benefit pension, or the old pension scheme as it is more commonly known as. The old pension scheme was structured in a manner such that you were eligible for 50% of your last drawn salary, and that salary would grow at the rate of dearness allowance, and which means that you would also be inflation indexed. So you would get 50% of your last drawn salary, it would get inflation indexed, and it will also get wage cost indexed. What do I mean by that? If somebody retired at the position of, let's say, joint secretary, and in the pay commission, if there's a revision in the joint secretary's pay, then the retired individual's salary would also get reset in such a manner that he would start getting 50% of whatever was the reset salary of the joint secretary. So it was last drawn salary linked, it was inflation adjusted, and it was wage inflation and wage indexed as well, right? So it was a very powerful and a very compelling scheme from an employee's perspective. But had we continued down that path, we would have faced serious fiscal challenges. And I think the government at that point of time in 2002, 2003 realized this, and they came up with a committee of experts led by Dr. S.A. Dave, who used to be the chairman of UTI at some point of time, and then eventually he chaired this committee called the Oasis Committee, and the Oasis Committee came up with a recommendation of NPS. And NPS, if you look at this product was created 20 years back, but each of the benefits and the feature that this product carries is so topical, which means that even today, each of the features that you will see there in this product will resonate with you. In fact, this product, I believe, was ahead of its time when it got launched, and obviously it got launched only for government employees when it was launched, and then in 2009 it was opened out to the private citizens, as it is called, the non-government employees, and then in 2011 it was opened up for corporate employees as corporate NPS. So it's a simple product. Essentially, you invest a certain amount of money during the course of your working life. As we speak, you can continue to invest till the age of 75. Earlier, it used to be only till the age of 60, but you can invest till the age of 75. Any individual, right from birth till 70, can open an NPS account. Right, and the reason I'm saying right at birth is because there is a product called NPS Vatsalya, which was launched for children in the year September 2024. Last year, September, is when the finance minister launched that product. That's a product which is meant for children between the age of 0 and 18. And then that product can then get migrated into a normal NPS. So NPS Vatsalya is meant for children. So that's the reason why I say from 0 to 70, you can open an NPS account. You can contribute to NPS right till the age of 75, which is when you need to which is when the product will exit you. Right? So it's a product that you invest in during the course of your lifetime, during the course of your working life, post your working life also if needed, if you feel like, and post the age of 60, you can potentially get out of this, you can exit the product, right? Some benefits that I've written here, but I would really want to use the next few slides to explain to you the benefits of this product by busting certain myths that are there around this product. And I'll talk about each of these things in terms of performance, fund management, tax benefits and various other flexibilities that are available. Under NPS, there are broadly two types of investments that are the investment styles that are there. One is what is called as the auto choice investment scheme, and the other is called as the active choice investment scheme. Under the auto choice investment scheme, which is, I'd like to really call it the fill it, shut it, forget it product, where you essentially choose one of these life stage investment options, and the product does the rest of it on its own. All you need to do is to continue to invest on a regular basis, and asset allocation, rebalancing, all of those things will happen on its own. The product is designed in such a manner that it will sort of keep reducing the risk in your portfolio as you get older. That's the auto choice option. The active choice option is one where you do it yourself. You can go up to a maximum of 75% in equity. And in the other products, of course, you can go up to 100%. And alternate investments, you can go up to 5%. So within these, guardrails, within these boundaries, you can build your own portfolio. And the asset allocation that you set, the system will continue to maintain that asset allocation till the time that you choose to change it, right? So that broadly the way the investment structuring is done within NPS. Now, this is yet again something that I really think is a biggest myth. 8 out of 10 people that I have met, and I'm saying this from my own experience. Some of it is anecdotal, and I also sort of conduct these polls from time to time when I address audiences on NPS. 8 in 10 people believe that this is a 50,000 rupee tax saving product. इसमें क्या बड़ी बात है, right? And that's typically the refrain that I hear whenever NPS. Yeah, I know there is some 80CCD benefit, 80CCD 1B benefit there where you get more than 1.5 lakhs. Old tax regime is no longer valid. Nothing can be farther from the truth, in my opinion. This is, and I will try and explain to you what benefits NPS offer you beyond this 50,000. Of course, the 50,000 tax benefit is available to any Indian, provided in the old tax regime. But there is a lot more to this product than just this whole 50,000 rupee myth. And I'm going to use the next few slides to talk about 5 myths which I think are the most commonly held beliefs about NPS, which I would want to sort of bust. The first of these is NPS delivers middling returns or low returns. And this is data which is as of April 2024. This is obviously changed, and I will of course share with you the December 2024 data as well. In fact, the Jan 25 data is also there, but I'll share the December 2024 data on the screen so that you're able to see what are the 10-year returns, what are the 5-year returns, what are the 3-year returns. In fact, returns from NPS have actually been superior to large cap mutual funds. And I'm not here to sort of compare or contrast between large cap mutual funds and NPS. Each product has its position in a portfolio. I hold mutual funds in my own portfolio, and I'm sure Tarun advises you on mutual funds and various other products as well. But the point I'm making is that it's not very well known that NPS funds have actually done better than a number of market linked products that are there. And this is one of the first things that I always talk about, which is not just on equity, but on corporate bonds as well as on government securities. And this slide only talks about corporate equity, but I'll show you a slide where you'll see the 10-year returns on equity, you'll see the 10-year returns on corporate bonds, and 10-year return on government securities. On all 3 vehicles, on all 3 asset classes, NPS as a product has done exceptionally well. The second myth really is the fact that the 50,000 rupee tax benefit product, we spoke about it earlier. In fact, there is a very powerful tax exemption that is available even under the new tax regime, that is referred to as the 80CCD2 section. Under the 80CCD2 section, 14% of your basic or basic plus DA, as the case may be, depending upon what the structuring of your salary is, and 10% in the old regime. So if an individual is in the old regime, then they only get a 10% benefit. But 14% of your basic is what you can set aside in NPS and therefore save your marginal rate of tax. The reason why I'm saying this is because it gets treated exactly the way employee provident fund gets treated. If those of you who are salaried, or those of you who are in business but also draw a salary from your respective businesses, as long as your company offers corporate NPS as a vehicle, as a product, which enrolling for corporate NPS is as simple as just reaching out to a point of presence like us, and we will enroll you into corporate NPS. It's a 24-hour process, and then after that, this product can be offered to everybody in the company. 14% of basic can be set aside. Of course, there is a cap of 7.5 lakhs. which is itself fairly generous in my opinion. But below 7.5 lakh, whatever contribution you make towards NPS, of course, there are three products which are there in the 7.5 lakhs. It's employer contribution to provident fund, NPS contribution, and third is superannuation. Superannuation as a product has really sort of died out, except for some PSUs where superannuation continues to exist. But this is a very powerful tax exemption that is available, but very, very poorly known. In fact, there are CFOs of large, medium-sized companies that I talk to, and when I tell them that this is something that's available to them, most of them continue to be sort of completely unaware of the kind of benefits that are available. In fact, if you look at adoption of NPS in corporates where it has been rolled out, adoption levels are around 8 to 10% only, and that's because of the fact that awareness around this product is very, very low. Awareness around this benefit is very, very poorly known. Of course, the 80CCD 1B benefit is available. We spoke about this earlier, which is 50,000 under the old tax regime. NPS Vatsalya contributions also qualify for that. May not be a very meaningfully large amount, but it's still a number that is material. On accruals, and the reason why I'm talking about accruals being tax free is because the comparative product, which is essentially employee provident fund, right, EPF, where any accrual beyond 2.5 lakh is charged to tax at marginal rate. Compared to that, a product like NPS, which is market linked, unit linked, there's obviously no tax on accrual. On maturity as well, there is zero tax on capital gains, right? Now, I know for a fact that a number of you will have this question that, but you have to take 40% of annuity, which is true. And the income that you will make from that annuity will be charged to tax. Absolutely correct. But the reality is that the corpus that you get at the time of maturity is fully tax free, by which I mean that corpus will not attract any tax. 60% of that corpus anyway is available to you completely tax free, right? And if I were to do a comparison, because of the fact that you get a tax advantage compared to, let's say, an actively managed fund, and I'm just taking an example of comparison between how NPS can potentially give you not just significant accrual gains, which is because of the fact that it compares very favorably with market linked returns and other market linked products such as mutual funds. It compares very, very favorably, but also there is a significant tax advantage that the 12.5% that you pay at the time of maturity is something that you don't pay here, and therefore there is a significant amount of benefit that you get both in terms of accrual, both in terms of the initial investment accrual, and of course exemption at the time of maturity as well. And there are some calculations that we put together, and this is just may not necessarily be very relevant for you, but essentially what this is saying is that this can actually give you a fairly meaningful corpus and give you a lifetime earnings in the form of annuity income. And I'll share some more details as we progress. Now,
I think since if the last slide, what you just show, since this was a very relevant slide, you mentioned that. Sorry, I'm asking question now, but I think let's keep clearing the doubts here only. So the EPF under 80CCD 2, investor has an option. Employees have an option to invest into EPF also, right? Compared to NPS.
That's correct. That's a good
And
point.
that is where,
I'm glad that you brought it up. Yeah. Is there any? Yeah. Please continue. I didn't want to interrupt you.
Yeah. So I get a lot of questions that it actually gives me a debt allocation. I think EPF is my quasi debt allocation. I keep doing a lot of mutual funds, equities for my equity allocation. So with this, does that changes?
So I think so. The question is EPF. In fact, I have an EPF account, and I've had an EPF account since the time that I started working. That's my data allocation. Fair enough, right? I mean, there is absolutely no disputing the fact that it can be a meaningful data allocation. The question that I would like to ask is, if you were given a 25-30-year time horizon to invest, what would be your choice of investment product?
Sure.
Right? So I think if you look at, and I am not for a moment suggesting that EPF is not a good product. It's not my job to compare product A versus product B. But I genuinely believe that if you have a 25, 30, 35-year time horizon, which is essentially what you have once you start generating income at the age of, let's say, 25 or so, you've got a 35, 40-year time horizon in front of you to build a retirement kitty. What should be your first choice of asset class? We all know that with time, the risk of losses in equity and a basket of equity, not necessarily a stock, but a basket of, let's say, equity stocks, the risk of capital loss diminishes, right? It goes to zero. We all know that, and I'm sure
Right.
Tarun, you've taught your investors
Sure.
this lesson many times over. But I think it's worth repeating that if you have a 25, 30-year time horizon, the probability of making double-digit returns compounded
Yeah.
over a 25-year time horizon is truly unparalleled, and that NPS offers. So, would you want to be in a product that potentially offers you single-digit returns? More importantly, single-digit returns which are coming down.
Yeah.
When I started working, I mean, the EPF returns that I used to make was around 12%, maybe more than that. I don't recollect now, right? Today it's around 8%. And I'm telling you, it's going to be very difficult for a vehicle which is largely invested. And I know 15% of incremental corpus is going into index funds, but it's going to be very difficult for EPFO to continue to declare high rates of interest. I know it's a politically sensitive subject. I know it's very sensitive, and therefore they are under a lot of pressure to declare meaningful returns. But it's going to be very difficult to keep that up, right? Also, I think it's important for us to consider this, right? If you look at EPF, at the end of the day, it's a very opaque vehicle, right? How many of us know what is happening to the money sitting in EPF? I have no idea, right? I just know the broad investment thesis that they have, but beyond that, I don't know how many skeletons are there in that cupboard, right? I would like to have complete control on the money that I'm investing, especially the money that I'm investing for my retirement, right? So I would therefore prefer, that's my preference, and that's me, that's completely, my view. I'm not saying that's a
Sure.
that's a view that everybody should, ascribe to. But I think having control of where the money is going, where is it getting invested, what is the cost that I'm paying, is something that is very critical, right?
Sure.
To that
Sir,
extent, I think, yeah,
couple of points. I think we have a limit of 7.5 lakhs, right? We can't invest more than 7.5 lakh under 80 CCD2, right?
very true. Yeah, very true.
Right.
So there is a total cap of 7.5 lakhs, which is what I mentioned. There are three products that come under that: employer contribution to employee provident fund, employer contribution to NPS. When I say employer contribution to NPS, it is essentially the employee's contribution which is getting routed as an employer contribution. The moment you ask your employer to contribute towards NPS, it gets treated as an employer contribution to NPS. And superannuation. There are some legacy companies which still have a superannuation scheme, but most of the new age companies don't have a superannuation scheme. Superannuation schemes have pretty much sort of died down, barring some PSUs where it still continues to exist, and most of the superannuation is now moved to NPS,
Sure.
right?
And sir,
So,
the last part is maybe I just wanted to add on this 23% higher terminal corpus. So I think this maths of 11.07 CR and how this apple to apple comparison works, I think some insights on that will be very
I'll share
helpful. I
I'll
think
share
maybe.
the I'll share the detailed calculation with you as well slightly later. I'll share the detailed
Sure,
calculation.
no problem. Sir, you can continue. No problem. Yeah.
Sure, no problem. Yeah. Now, when it comes to flexibility, just give me a second. I'll call you. Yeah. When it comes to flexibility, I think there are a slew of flexibilities that are available in NPS which are not very well known, right? And I would like to, focus on those. Forget about, flexible contribution. Of course, that's a very minor thing. Most products offer that. I think the key flexibilities that are available and that I think is relevant for your for this audience is one, of course, you can invest in E, C, G, and A: equity, corporate bond, government securities, and alternate investments. I spoke about the auto choice and the active choice earlier. So, as an investor, you can choose to go the auto route or the active route. If you take the active route, you can go up to 75% in equity. By the way, if you like fund manager A for equity, fund manager B for government securities, and fund manager C for corporate bonds, you can choose that, which means that you could build a portfolio where the best of the fund managers, in your opinion, in your estimation, based on whatever study you do, based on past performance, based on other things that you would look at, you can actually choose a different fund manager for different asset classes, right? Which means that if you're investing, let's say, 50,000 rupees a month or 25,000 rupees a month, and if you're, let's say, allocating whatever amount of money towards these three asset classes as an active choice investor, you can choose which fund manager your money goes to. So there is not just flexibility in the form of how much you can invest, you can have flexibility in the form of who you can invest with. So there is a fund manager choice out of the 11 fund managers that are there in the ecosystem at this point of time. You can choose to go with any three of them. For each of these could be with a different, and of course all three could be the same fund manager. Nothing stops you from doing that, but that flexibility is available. The other flexibility that is available to you is that every year you can actually change your asset allocation, and I'm not recommending it. I'm not a big fan of this, but the reality is that it offers you flexibility to change your asset allocation 4 times in a year. It offers you the flexibility to actually change a fund manager once a year. All of these changes can be done at zero cost, zero taxes, right? Now, within the asset classes that you allocated money to, this product is built in such a way that it automatically rebalances your portfolio at every birthday, which means that if somebody's birthday is today, and if you started investing, let's say 5 years back, on your birth date, it will rebalance your portfolio as per your choice under active choice or as per the defined asset allocation under the auto choice. So this does automatic rebalancing between asset classes on every birth anniversary of the individual, right? So you don't have to really worry about asset allocation getting skewed. Equities, if they've done exceptionally well, it will get rebalanced at the time of on these birth anniversaries, right? It is portable, by which I mean that if you move from company A to company B, if you're a salaried individual, and if you move from company A to company B, moving the NPS account from company A to company B is a 3-day process. It takes you just need to make an application to your new company, and it'll automatically get ported. There is a single permanent retirement account number. It's called a PRAN number, permanent retirement account number, and you can actually open an NPS account in under 5 minutes. The entire process is completely digital. All you need is a CKYC and, of course, the bank account, and you can get your NPS account up and running in a matter of under 5 minutes. And of course, it also now started reflecting in the consolidated account statement which NSDL and CDSL has started sending out to customers now over the past few years. Right?
Sir, I think the last slide was very important one in terms of automatic rebalancing. I think this is extremely lethal, right? I think when I look at it, I think today, let's say if I am in mutual fund schemes or portfolio, I do any equity to debt, I end up paying entire taxation, right? 12.5% taxation for any rebalancing done. You are saying that 4 times in a year, I can do rebalancing without any tax outgo.
Absolutely right. No tax, no cost.
So my just worry is in a retrospective, once NPS become very powerful, do you expect this to be taken away? Because I think this is extremely, I don't find it very normal, right? It's from a product perspective. Maybe to bring acceptability, it has been done.
Yeah, I think the way the product has been, I mean, I can't talk about the future, but I don't think this is this is an integral part of the product features as far as NPS is concerned. And therefore, I don't expect this to undergo any change in terms of, see, at the end of the day, what's happening, of course, there is a redemption that's happening from equity to corporate bond or corporate bond to equity, as the case may be, when you do a rebalancing of your assets. Uh, but I don't expect this to change, anytime in the near future. This is my expectation. I can't, of
Sir,
course.
any global precedents there? Let's say US has a very successful 401k, and I know I'm sure you have a lot of perspectives on that. So is this on lines of US 401k what we are trying to do in NPS here?
So the difference in 401k and NPS is that 401k offers you a basket of different types of funds that are there, right? So there could be funds managed by fund manager A, fund manager B, fund manager C, and within fund manager A itself, they could have multiple funds under that itself, right? NPS, on the other hand, is a single vehicle, right? And it offers multiple investment schemes therein. But the product itself has been, as I said, designed by the government in some sense, and PFRDA is the one that regulates the product. The product is very clearly defined and constructed, and the features of that are monitored and sort of modified as the case may be. And we keep making representations as pension fund managers and points of presence to the government, and they sort of, the systematic lump sum withdrawal, which we'll talk about slightly later, it was one of the most recent, last year in October is when it was introduced. There's another very interesting life cycle fund which is called Balanced Life Cycle Fund, which was introduced. Balanced Life Cycle, yeah, BLS, BLC as it is called. BLC, there is LC25, LC50, LC75. I don't want to sort of bore you with the acronyms, but there are some very interesting auto choice schemes that are available where all you need to do is just put the money in there, and for the rest of your life it will keep managing the asset allocation between equity, debt, and corporate bonds,
Wow.
over the lifetime of the product. And during the course of this, you don't have to pay any taxes, you don't have to pay any costs.
And sir, this automatic rebalancing available both in tier one and tier two, right? Both there we can do both
You can,
with the
in
same
fact,
tax benefit.
you
Yeah.
can. In fact, in tier two, it offers you the
Sir,
flexibility.
I think if you want to give an idea on tier one and tier two, because not many would be aware of tier one and tier two,
I will.
if you
I will.
can
In
give
fact, I'll
that.
come to tier two in the towards the end. I have a slide on tier two, and I'll talk about tier two there. Yeah.
Sure.
All right. This is another thing that I keep hearing, that illiquidity यार NPS में एक बार पैसा डालो तो फंस जाता है, right? And and having spent time in the investment business now for some time, and having seen investor behavior, this is the only product where the investor return and the investment return for a certain period of time is exactly the same, right? And I'm sure all of you heard this, the spiel about investor return being investment return being something else. So many funds get quoted saying इस fund में 20% CAGR बना है, but किसी investor का नहीं बना है, right? So I mean, no investors have made it, but the fund has delivered 20% return, 21% return, 22% return, right? The reason that happens is because all of us are victims of our own perceptions. There is so much of noise in the market. There is so much of gyan that gets offered by various people in the market, and we do get distracted. And there is nothing wrong in that. That's human nature. That's how I have behaved in the past. That's how everybody behaves, right? Fortitude is what we lack as investors, and therefore we come in the way of our wealth creation journey more often than not, right? As a product, NPS, given the fact that it doesn't have too much of a liquidity, by which I mean, once you start your journey in NPS, of course, there are certain small, amounts that you can take out. 25% of your contribution into NPS you can take out thrice during the entire, life of the product. But it's only 25% of the principal that you've contributed. It is not a very large amount. It is not meant to offer liquidity. The fact that it doesn't offer liquidity is actually going to help you, right? And that's sort of demonstrated by this graph. And we've taken this data from June 2009 is when the product got launched for all citizens, right? And we've compared a product NPS as it exists today, and somebody would invest it, let's say, over this period of time, 4,000 rupees a month, roughly 50,000 rupees a year, with some increase in contribution and and increments over a period of time, it would have grown to, let's say, 75 lakhs roughly, right? Had we had an NPS with an exit opportunity or with an exit option, what would have potentially happened, right? And the number that you see here is 41 lakhs. The differential is 32.5 lakhs. Let me explain to you how we've come to this. The way investors behave is that whenever there is a, let's say, 5, 6, 7, 8% correction, most people, say our average out karne ka time hai, we should put in more money, markets have corrected, market is healthier, let's put in more money. The moment it corrects to 10%, people say, let's take a pause, let's wait for it to settle down, and then I will get back into the market when there is a firm direction that the market shows. There have been two instances in the last 15 years when this happened, right? And you can see those two instances marked by those two squares, right? What tends to happen is that investors tend to, and I'm not generalizing here. I'm sure this investor is, this set of investors on this call are fairly sophisticated. You sit through market turbulences and so on and so forth. But more often than not, in my experience, 85 to 90% of investors tend to pull the plug and stay out of the market when the market gets very, very, very choppy. When the market there is a very sharp correction, people sort of tend to stand on the sidelines, and they get back into the markets once it has come back to the earlier highs or has crossed the earlier highs, right? And if I were to replicate that behavior on NPS, what would have ended up happening was you would have only ended up with a 41, 42 lakh rupees, which is a significant difference with and this is actually 74.3 lakhs is an actual investor's return. By the way, those people I meet who have started their NPS investment journey in 2010, 2011 are absolutely thrilled with the kind of investment returns that they've seen, because you don't look at this portfolio every day. You don't look at this portfolio even once in a month. You look at this portfolio probably once in 6 months and say, let me look at this. Something is going from my salary. Let me see what is happening. And I can tell you, I've come across so many investors who started the year in 2010, 11, 12 because somebody told them to start and have continued to invest since then. They are mind boggled in the kind of investments, the kind of returns that this investment has made. So I think illiquidity is, in fact, in my opinion, one of the biggest positives about NPS. The moment you offer liquidity, we ourselves are going to come in the way of this vehicle delivering returns, right? And that's another thing that I think is
Sir,
important.
this is one of the most amazing point, and we deal this day in day out dealing with investor return and investment return. And
Yes.
I think in US, that one study was done that who has made the highest return, and I think the data showed the people who have died,
Yes.
and their money is lying in their demat for custodians for long period of time. The biggest returns were made there, right? So
Absolutely
yeah,
right.
yeah.
Absolutely right. Absolutely right. And this product, given the fact that it doesn't allow you to get out, you will willy-nilly end up making, returns which are what the vehicle has delivered in the same period of time, right? Because you can't
So
get out, get in and get out. The other
so
thing that I keep hearing about is that this 40% annuity खरीदने का जो झंझट है last में, right? And lot of sophisticated investors seem to think that annuity as a product gives very low returns. And let me give you some color on this, right? Number one, nothing could be farther from the truth, right? And having seen various kind of financial products, I can tell you with 100% conviction that there is no other product, and I'll repeat this, there is no other product which gives you a guaranteed rate of return till one is alive. There's no other product. Annuity is the only product that offers a guaranteed rate of return. So the longevity risk is taken over by the annuity service provider. And the annuity service provider is essentially an insurance company. Insurance companies are essentially expected to do only two things. Of course, it's a different matter that they have a number of other products as well. But there are two risks that you protect yourselves against. One is the risk of dying too early, and the second is the risk of living too long. Right? Annuity is a product which actually serves you to and actually mitigates the risk of one living too long by taking over the longevity risk from you. Let me give you an example. In the year 2010, right, annuity products used to offer a return of 11.5, 12%. Okay. The rates today are on annuity anywhere between 6.75 and 8.5%, depending upon what option you choose. Right? There are return of purchase price options, and there are options where the purchase price essentially is not given back to the nominee. The returns there are as high as 8.5, 8.5, 8.75%, 9% actually. Right? So if you look at, and I gave you the example of somebody, who would have bought an annuity product in the year 2010, imagine what that person would be thinking about today. Wish I had invested more at that point of time if I had the money, right? I'm telling you, this is going to play out again. And this is not a secret. I'm not revealing any big secret. This is something that all of us know, right? Again, I'm sounding like an old man, but when I started my banking career, we used to offer, and I used to work for a foreign bank, and we used to offer 14% returns, 14% rate on fixed deposit. This was a bank which was AAA rated in Amsterdam, right? And we used to offer a 14% return, rate of return in India. And of course, I'm sure those of you who've been in the investment markets for long enough, you know that NBFCs used to offer 18% per annum. Those were the days, right? This was 94, 95, 96. Today, we're talking about single digits, right? Middling single digits, right? While I think there will be interim periods of volatility, rates may go up, rates may come down, but in the long term, fixed income rates will come down, and that's the sign of a developing economy. India, as it develops, you will see that rates are going to come down, which means that if there's an option for you to lock into a particular rate at this point of time, and let me tell you, the differential between annuity rates and 30-year GSEC rates is not more than 10 to 15 bips. Right? It's a very small difference, right? That has to be given to the insurance company or the annuity service provider to take care of your longevity risk, right? So there's a huge risk that the insurance company is taking or the annuity service provider is taking by giving you an annuity. And annuity rates have become very, very competitive. In fact, if you look at the annuity rates now, it is anywhere, as I said, between 6.5% and close to 9%, depending upon what option you choose. Also, annuity as a product has become a lots more flexibility, right? I mean, there are annuity products where you could defer your annuity by 5 years and 10 years. In fact, yesterday I was talking to another financial advisor friend of mine, and he said, listen, boss, this 24 lakh, this 12 lakh rupee, this limit that has now come into play, I can actually offer an annuity to my client, and the client can actually take home. Of course, assuming that there's no other interest income that the customer is receiving, you can actually take home a lakh of rupees every month and still not pay any tax. I said, of course, that's true. He said, if I can split it between the husband and wife, it can actually become 24 lakhs. I said, of course, that's true. Of course, there's some hypothetical. I mean, we're thinking that there is no other interest income and so on and so forth, which may not be the case, right? But the point is that the current tax regime, while annuity is treated as salary, and therefore it will be treated as salary income in the hands of an individual, but the kind of limits that we now have under the new tax regime and under the, of course, the recently announced budget, very, very compelling to actually buy annuity. And as I said, this is the only product that gives you a guaranteed rate of return for the rest of your life. In fact, there are very interesting combinations. Deferred annuity is one option. As I told you, 5 years and 10 years later, you could start receiving the annuity income. In fact, 5-year deferred annuity, if I remember correctly, is around 8.8%, right? And while the IRR will be the similar to an immediate annuity, but what matters to you really is cash flow, not IRR, right? At that age, what matters to you is cash flow, right? If you're able to defer by 5 years or defer by 10 years, you can actually make a very meaningfully large cash flow that can come to you on a month-on-month basis. And of course, there are annuity products which have been launched over the recent months, where the annuity can actually go up every year in terms of and is in some sense inflation linked. India still doesn't have an inflation-adjusted annuity, which I think is expected to get launched sometime. I mean, the regulators are considering it, but I think some very interesting options have emerged on this space as well. So broadly, these are some of the things that I thought are relevant. These are some of the things not very well understood, and I'll now come to some
Sir,
key metrics.
sir, annuity, there are two, three things which I think we can clarify now only. One is
Please.
the operational aspect. Is it very easy to move in annuity? Let's say somebody retired and at that time, one has to choose the option, right? How does this work actually? And I can select which asset allocation plan I need to take. It's a debt only structure, or there are options to take equity in that also. Because
Right.
just because I'm retired, I don't want all my money to go in debt in that part also.
Right.
And again, locking the rate. You spoke about locking the rate. So I just want you to share a hypothetical example. Let's say for 15 years, every year, let's say I am putting the highest amount, 7.5 lakh rupees. So some part of that money goes in debt. Let's say I've taken the equity option. So 25% is in debt. For
Mhm.
15 years, that money which I'm giving, that money you are saying getting locked at today's rate, right? So
I'll try
yeah,
and
how
clarify.
does it work? Yeah, those
Arun,
things.
I was not. I don't think I was very clear about this. Let me try and. So what happens is that once you finish your NPS accumulation journey, so there are two parts to this journey, right? So there's an accumulation journey and there's a consumption journey. Accumulation journey is a
So,
journey that you have till the age of 60 or 65, as the case may be. I mean, as a self-employed individual, you could choose not to retire at all, right? I mean, you could continue to generate
so
income till the age of 70, 75. NPS as a product allows you to remain invested in NPS with whatever asset allocation that you want to choose, of course, in the active choice scheme, up to capped at 25% in 75% in equity. You can remain in NPS till whatever time you choose, right? Once you choose to exit from NPS, the corpus that you have accumulated, 60% of that corpus comes to you tax free, no questions asked, right? Which means that in the earlier example that I showed you, there is some 11.56 crores, which I will again talk about, of course, subsequently. 60% of that corpus is back to you. Whatever is the corpus that has got accumulated in through whatever asset allocation that you've done, 60% of the corpus comes to you tax free. The remaining 40% has to be used for purchase of an annuity plan, right? There are broadly two categories of annuity plans. One category is referred to as annuity plans with return of purchase price, right? Which means that there is a certain rate of return that will be given to the annuitant through the life of the annuitant. On the demise of the annuitant or the purchaser of the annuity, the corpus that was used for purchase of the annuity will go to the next of kin, to the nominee, right? So that's essentially like a lifetime fixed deposit, if I were to equate it to that, right? It's like a lifetime fixed deposit with a fixed rate, right? The second type of annuity product, and this could be single life or joint life. That's the other variant that's available. So return of purchase price, single life or joint life. What do I mean by that? Single life could be just I am buying it and on my demise, the corpus will go to my nominee, right? Or I could also have a joint life, right? Which means that I am the primary annuitant and my spouse is the secondary annuitant. On my demise, my spouse will start getting the same annuity, the same monthly cash flow, right? That in case I've chosen a monthly option, you can choose a quarterly and a half yearly and a yearly option also. But let's say I've chosen the monthly option. This monthly payment will start going to my spouse. On my spouse's demise, the corpus that is there, which was invested at the time of buying the annuity, goes to the nominee. That's a return of purchase price option. The other option is what is referred to as life annuity, which is without a return of purchase price. The rates there are typically 1 to 1.5% higher. So if the rate here in a return of purchase price option is let's say 6.5%, the rate of return on a non-return of purchase price option, or it's referred to the life annuity or the joint life annuity, the rate there is around 8.5%, 8 to 8.5%, right? There, on demise of the individual, if it is a joint life annuity, then the pension or the annuity starts or the cash flow starts going to the spouse. And on the demise of the spouse, end of story. The money doesn't go back to the nominee, right? So that's the difference between. So these are broadly the two categories of. So I hope I've been able to answer. Annuity
Sure.
kicks in at the time of exit from NPS. At the time of NPS, 60% is available to you tax free, 40% has to be used for purchase of an annuity, and I explained to you what the annuity options are. I hope it's clear now.
And this 25% in the equity option, which goes in the debt, that basically ensures that there is a protection, right? That
Yeah, that's
40%
a product.
annuity.
That's a product construct. So one could choose to be 60% in equity, 50% in equity. The remaining 50% can be in corporate bonds and government securities. It's entirely your choice. 75% is the cap on equity exposure in tier one. In tier two, by the way, there is no cap. You can do 100% equity. Nothing
All
stops
right.
going 100% in equity. Of course, tier two account you can have only if you have a tier one. You need a tier one to be able to have a tier two, and I'll come to tier two subsequently. I'll quickly run through the
Okay.
next few slides.
Sure, sure, sure.
The first point is the tier 2 option which we spoke about. What is tier 2? Tier 2 is nothing but the same NPS account but without any tax benefits. What do I mean by that? So there is no tax benefit at the time of investment, there is no tax benefit at the time of exit. But there is a very powerful feature that is available in tier 2. Number one, it is a fully liquid vehicle, right? It's a fully liquid vehicle, by which I mean you can get in and get out at your choosing, right? You can get into tier 2, you can be 100% in equity, you can be in 100% corporate bonds, you can be in 100% government securities. Whatever asset allocation you can want, you can do within tier 2. The second thing, which is very powerful and again not very well known, is the fact that at the time of superannuation, at the time of your exit from NPS, you can actually move your entire tier 2 accumulated corpus to tier 1 without paying any taxes, right? There are two options. Either you invest in tier 2 and get in and get out, right? Or you choose to remain in tier 2 before you're superannuating or before you're exiting from NPS or before you're retiring and you want to take the money out from NPS, you move your tier 2 corpus to tier 1. What happens? The moment you move your money from tier 2 to tier 1, it gets funged into the tier 1 corpus, which you accumulated through your savings under tier 1. And that entire corpus, 60/40, is available on that entire corpus, right? Which means that tier 2 is essentially a liquid mutual fund equivalent product at a marginal cost. Let me tell you the cost that the fund management fees in the NPS ecosystem, given the fact that it is a government regulated product, the fund management charges, and you will fall off your chair if I tell you what the fund management charges are. The fund management charges are between 0.03% to 0.09%.
Sir, I was coming to that question. How would you bring that firepower in returns, right? In the equity
So I'll
returns.
show you
So,
the returns. The proof of the
yeah.
pudding is
So,
the eating, right? So I'll
yeah,
show you,
yeah.
I'll show you what returns NPS funds have delivered,
But
right?
tell me something. So somebody, let's say at age 56, enter into a tier 2 NPS,
Yeah,
and for 4 years he continue to invest in tier 2.
yeah.
And you are saying at age 60 he can move into tier 1 at that time.
You
Okay.
can move
And
anytime.
there, yeah,
You
and
can move anytime.
60% completely comes tax free and 40% goes to annuity for him,
That's
right?
correct. That's correct.
Right? Okay.
That's correct.
Okay.
So you can actually use tier 2 as a parking vehicle or as an investment vehicle, but more importantly and more powerfully, you can actually use the tier 2 investment, keep putting money aside in tier 2 before you exit from NPS as a as an investment option when you want to exit at the time of 60 or beyond 60. Move that money from tier 2 to tier 1. It's called a one-time shift. The shift happens from tier 2 to tier 1, no tax implication, and then then that becomes a part of the tier 1 corpus, and tier 1 is of course 60/40 as you explained, right? The other very powerful feature that I want to talk about is what is called a systematic lump sum withdrawal plan, which got introduced by the regulators last year. Last October, I think it was early last year. I think it was maybe April or May of last year is when the systematic lump sum withdrawal got launched. And this table below is just a simple, explanation of what can happen if you start at the age of 25 to 40. I mean, this is just taking a age range from 25 to 40. If you've contributed 2.5 lakh rupees per year, and there are some notes there at the bottom as to with the assumptions on what is the assumptions that have been made. If you can actually, and this table essentially tells you that NPS on its own can potentially become your sole product to manage your base expense requirement at the time of retirement, right? And so this is a 2.5 lakh investment that we are making on a yearly basis, which is a very, it's a very modest amount that I'm talking about, but of course it can be multiples of that. By the way, unlike in public provident fund where there is a cap of 1.5 lakhs that you can invest, there is no such cap on NPS. You only get a tax benefit of 50,000 as a retail individual under 80CCD 1B or 7.5 lakhs as we spoke about earlier under the corporate NPS scheme. But nothing stops you from investing 50 lakh rupees also in a year, right? And take advantage of the fact that on accrual there is no tax and on maturity there is no tax, right? So irrespective of whatever is your contribution amount, your end corpus is tax free. 60% comes to you as commutation, the remaining 40% you have to buy an annuity. Here, what we've tried to show is the comparison of if you were to use both these features, which is the annuity feature and the systematic lump sum withdrawal out of the 60% commutation that you've made. So let's say in the first example, let's just take an example of a 25-year-old individual who started investing at the age of 25, put in 2.5 lakhs over a period of 35 years, 12.5% return, and there is a, of course, there is an increment that there is, people tend to increase their investment over a period of time. Some of those assumptions have been made. This can potentially become 13.65 crores. 60% of that, which is 8.19 crores, is the amount available to you to take away, or you can continue to keep it in the NPS vehicle. It can continue to grow depending upon what asset allocation you've chosen, right? So you're exiting from NPS, you're taking away 40%, buying an annuity plan. Let's say that annuity plan is only at 5% because we're talking about, let's say, some time from now. Let's say you're going to get only 5%. You'll get a guaranteed return on that or a guaranteed cash flow on that based on whatever is the rate of return on annuity at that point of time for your lifetime. The remaining 8.19 crores, which is the 60%, which is commuted amount, you can actually let that remain in the NPS vehicle. You have exited the product, but it can remain in the NPS vehicle. You can change the asset allocation, right? Which means that let's say at the age of 60, let's just take the example of 8.19 crores which you have accumulated. You can take that out without paying taxes. Let's say you let it remain in the NPS vehicle. Let's say the asset allocation is 75-25, but you say, yeah, boss, this is too much of risk. Let me reduce my equity allocation. You can change the equity allocation to 50. 10 years later, you say, yeah, 50 is also high. Let me reduce it to 25. You can reduce it to 25. And then you can continue to withdraw from that. So the systematic lump sum withdrawal, actually, you can continue to do till the age of 75. Right? So by putting 2.5 lakh rupees per annum from the age of 25 years, and of course increasing it a certain percentage, and I can share the calculations with you, you can actually make 7 lakh rupees per month of income. And that is, of course, I've discounted it to present value because these numbers always look big, right? And my idea is not to sort of make some, crazy assumptions and show you some big picture. But you also discounted it to, let's say, at a 5%, right? 35 years later, if you're going to get some 7 lakh rupees, that's equivalent to 1.27 lakh rupee today, right? So if you start the journey early enough, right? If you start your journey, NPS alone as a product can afford you significant guaranteed cash flows. Part of it is, of course, from systematic lump sum withdrawal. part of it from annuity, and this product alone can actually make sure that your base income gets locked in, right? So both tier 2 and systematic lump sum withdrawal, in my opinion, are very, very powerful features, not very well understood. But I would urge you to sort of ask me questions if there are any, and of course, yeah, there is enough literature available for you to go through on systematic lump sum withdrawal. A lot has been written. I've written some articles on this, and I'm happy to share.
Sir, this 4.75 lakh, what you have assumed, so I'm assuming that 60% commutation of 8 crores, practically we are talking about annual 60 lakh rupees withdrawal, right? So
So
on 60 lakh, on 8 crores,
I'll explain this
yeah,
table to you.
yeah.
So the corpus that you have at the age of 60 is not
Hmm.
8.19, it is 13.65. Just take the first example. I'm just taking the first
Correct,
row,
correct,
right? 13.65, 60% of that is 8.19 crore, right?
right,
That 8.19 crore remains in the NPS vehicle, and you are able to withdraw at the rate of 4.75 lakhs per month for the next 15 years, because you will have to anyway shut the account at the age of 75. Right? You can't go hold the account beyond 75. At this point of time, that's what the law is, right? You can't hold the NPS account beyond 75, right?
so,
So this 8.19 crores of commutation, you let it remain in the NPS account, let it continue
hmm,
to earn at a conservative 6%. Let's say you move all the money to debt. You say, well, ये कोई
hmm.
risk नहीं लेना, उसको पड़े रहने दो उसके अंदर, 6% कमाएगा वो, right? And you continue to withdraw at the rate of 4.75 lakhs. By the way, at the end of 5 years, if you think यार मेरे को निकल जाना है पूरा, you can actually take the entire money out, right?
That's tax-free
That
money for you,
that
tax.
is tax-free money, right? That 60% is tax-free money, right? And then there is the annuity, the remaining amount that you used, which 13.65 minus 18.819 is 5.46 crores. You buy annuity with that. And that, let's say, if the rate at that point of time is 5%, you will get a monthly annuity of 2.27 lakhs, right? So a total cash flow of 7 lakh is rupees is something that you can create. Maybe you've not started at 25, you must start at 30, you can still create a cash flow of 3.75 lakhs. Of course, the present value of that, if I were to discount that 25 years, 30 years, 35 years hence to today's value, it's not a bad amount at all. If you're able to make a lakh, close to a lakh of rupees, uh,
Right.
this can actually take care of the base income that you require for some living expenses that you may. I'm not saying that this is sufficient for you to live your life, but this can take care of some base level income streams that will get guaranteed for you for a very long period of time. Yeah.
So,
Now, I'll quickly cover the NPS investment universe related to your question on where does it get invested. So broadly, quickly touch upon this. Equity, the benchmark that we follow is BSE 200 TRI, it's not TIR, Total Return Index, which is essentially all dividends added back as well. So that's what we get benchmarked against. So it's the top 200 stocks of the NSE is what is our universe. That's where we can invest. Of course, we can invest in IPOs as well. But if the IPO is not within the top 200 in terms of market capitalization, we have to exit it. So we're very careful about investing in IPOs. Top 200 is where our investment is. In fact, close to 70% of our investment will be in the top 100, and therefore, comparison of this with large cap mutual funds is the best comparison, because 75% of the investment is in. Because also, what we've seen is that this is retirement funds, right? So we have to be very careful with how do we manage. While within equity, there are different levels of risk that one can take, but at this point of time, the regulator only allows us to put money in the top 200 stocks. That's the universe. In corporate bond, the C
sir,
category.
sir, couple of questions on equity, just to the one which you took.
Yeah,
Can you go back to that old slide?
yeah.
So it doesn't allow those mid and small cap companies in this. And is it primarily you invest back into ETF and index funds, or you pick
Can
up stocks themselves?
No. So if you invest in ETFs or index funds, we don't make any fund management fee on that, by the way, right?
Sure.
So we have to actively manage it. There is no alternative but for us to actively manage it. Of course, we benchmark it against the index, and therefore we look at weightages against the index as well. But as I told you, this is a top 200 stocks. Top 200 stocks is the entire large cap universe and the majority of the mid cap universe. Top 100 to 250 is your mid cap universe, right? In as per market capitalization defined by SEBI. So you can actually invest in the top 200 stocks as far as India. NSE. We as fund managers can invest in the top 200 stocks. But traditionally, you will see that a large concentration of investment has happened in the top 100. In the last 3 years, we've started taking slightly higher exposure in the top beyond 100 as well. The last 25 stocks we don't necessarily participate in because PFRDA, 100 stocks, 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 100 monitors us very closely on what is our holding in beyond 200, because if some stock is at 195th, and the way markets move, and if there is, if that it moves out of the 200 universe, then I have to liquidate that within a period of 6 months. I mean, I get a 6-month time window to hold it, because, I mean, obviously there'll be impact cost, which if I try and exit that in a hurry. But the universe that's available to you is a mix of large cap and mid cap. It's not just
Okay.
large cap, right?
And sir, my another question is, how do you ensure you have the best fund management talent attracted towards you, right? So I think in the entire comparable space in the DII segment, domestic institutional investors, I think how do you stack up in the equity investing, at least maybe in the large cap category, because that's where
I'll
you
show
can operate, right?
I'll show you a CRISIL slide. In fact, that's the slide that we get benchmarked on, and I'll show that to you, and that's the proof of the pudding. I'll just quickly
Sure,
cover the corporate bonds and the government securities piece.
sure,
Corporate bonds,
sure.
75% of our AUM has to be in AAA or above, so we can't invest in. So there's only a certain amount that we can invest in AA. So by design, uh, we tend to sort of look at AAA. Our portfolio at this point of time is 91% AA. Oh, sorry, AAA. 91% of our investment in corporate bonds, which is roughly, as I speak, roughly 22,000 crores of money is what we manage on the corporate bond side. 91% of that is in AAA, right? And we are one of the largest buyers of, whenever there's a corporate bond issue, pension funds tend to be the largest buyers, because the I mean, like in SIP in mutual funds, once somebody signs up a corporate NPS, people normally don't stop, and so the inflows into this business are fairly healthy, right? So that's the corporate bond universe for you. And then there is, of course, government securities. It can be central government and state government as well. And we have a fairly large position here, close to 35,000 crores is there in government securities in our fund. And the industry, of course, is much larger. I'll just come quickly to the last. And of course, there is alternate investments. Now, this is not a very meaningful category, because of the fact that while it allows us to invest in AIFs as well, but given the fact that there is full liquidity available to the individual at a, not in terms of getting out, but as I told you earlier, you can 4 times in a year move your asset classes, right? So I need to make sure that I have sufficient liquidity to be able to manage this asset allocation change that an individual investor may do. And therefore, as a policy at this point of time, we don't participate in alternate investment funds. Largely, the A category invests in InvITs and REITs, and of course, tier one bonds issued by commercial banks under the RBI guidelines. So these are broadly the two or three. Not a very popular asset class. It is largely EC and G, which gets, we've been appealing for some relaxations in the alternate investment universe. It will require some product changes for it to become more prominent. At this point of time, we manage around 3,500 crores. Sorry, the industry is around 3,500 crores of, not even 3,500 crores. I think it's around 2,500 crores of alternate investment across the entire industry. It's not a very popular asset class within the EC and G is where most of the money is. But in any case, there is a 5% cap on how much you can invest in this under the active choice scheme. Now, this is the slide that I want to show you. This is a CRISIL, tracking that happens of performance of NPS funds against, in fact, the comparison happens with large cap mutual funds. As you can see, 10-year performance of scheme E1, and I've just drawn arrows to draw your attention to the relevant, because it's a very busy slide. I just copy pasted it because it's an actual CRISIL report, which we get monitored against by our regulators. So you see scheme E tier 1, you will see 10-year return is 12.6%. Large cap mutual fund category average is around 11.84. So both of these are averages. So that's 12.6 is average across the 11 fund managers. 11.84 is against the large cap universe. So the differential return is roughly 75 basis points, right? And I think that speaks louder than anything that I say. While, the cost structure is very low in NPS, it does create a challenge for fund managers in terms of making sure that we're able to attract the best talent. But companies like ours, especially HDFC as a group, looks at these opportunities as multi-decadal opportunities. So, and of course, with the support of our subscribers and the corporates that we work with, and given our brand name, we've had reasonable success. In fact, our AUM has grown 3 times in the last, 3.5, 4 years. And as you pointed out earlier, we're at around 1.1 lakh crores of AUM at this point of time. And with scale, you are able to definitely afford good quality talent. At initial stages, it gets challenging, but once you build scale, your ability to attract good quality talent, and of course, keep in mind that uh, your ability to really manage money. This is patient money, right? As you will all know, um, the fund manager is not, watching his back every day to figure out how much is going to get redeemed today. Of course, there are exits that happen from NPS because people superannuate, retire, but it's still a 20-year-old product, right? So to that extent, we expect most of the maturities to start happening only from the year 2035 or thereabouts, or beyond 2040 actually. To that extent, patient money, large amounts of money that you're dealing with, and therefore your ability to take some meaningfully large positions because it's very, very patient money, right? And you'll see that the returns that are there in corporate bonds, return that the fund is delivered in in the G categories in the region of 8.5, 8.6%. And these are category averages, mind you. So therefore, this is of course the high and the low could be slightly different, but most pension fund managers are in this ballpark, plus minus 0.5%, right? And this is
True.
an extract from the CRISIL report that we get, where we get tracked in terms of what our performance is. Just a last slide on what HDFC Pension is. We today manage 43% of the 1.06 lakhs is slightly dated, it's 1.1 as we speak. Close to 43% of the industry, which is non-government assets under management, is with HDFC Pension. We are also a very large distributor. It's called referred to as the point of presence business. HDFC Pension is the largest corporate NPS distributor or point of presence in the industry. We also have a very large retail presence. And we also work with a number of pension agents who choose to route their business through us. We are the point of presence. Pension agents can work with us. And 1 in 4 customers who have signed up for NPS on the corporate NPS side have chosen HDFC as their point of presence. And of course, 22 lakh subscribers, as you said earlier, right? So that's broadly the size and scale.
So, Mr. Iyer, I think on this question, I think operational side is where we get a lot of question. It's very hard for many investors who are interested in NPS how to get started. I think that's the large challenge which I myself also, when I had started myself, I
Right.
found it very difficult and how to do it, right? So, let's say employer option we are looking at the 14% of your basic part. So for that, what steps one has to take to initiate, because many companies don't offer it and all these questions keep coming, right? So how can we get started? Maybe if you can give us some insights on that.
Yeah. So firstly, I think you're right. I mean, 3 years back, the number of companies that had enrolled for corporate NPS was around 9,000. Today, there are 18,000 corporates that have enrolled for NPS. So I think practically most large and mid-sized and even small companies have signed up for corporate NPS. Now, what does it mean? What does signing up for corporate NPS mean? It's very simple. All you need to do is to work with the point of presence. HDFC Pension, as I said, is a point of presence. I'm more than happy to work with any of you who may be interested, who would have a corporate and you may want to sign up your employees for corporate NPS. So the point of presence is responsible for enrolling you onto corporate NPS as a corporate. If you're a corporate, talk to the point of presence. The point of presence will ask for some basic identification documents, essentially your MOA, OA, and possibly the PAN card, and that's about it, right? And it's a matter of 24 hours for you to set up the corporate NPS account for the corporate, right? Which means that there is a unique identification that is given to the corporate. It's called the CHO number. That number is given to the corporate. And once the corporate is empaneled or enrolled for NPS, corporate NPS, every employee is eligible for a corporate NPS account. And thereafter, the POP is responsible for making sure that they get the employee's NPS account opened or mapped to the corporate in case the employee already has a existing NPS account. That can also happen, right? So you could already have an NPS account. And if you're working for a company, company needs to sign up for corporate NPS. As I said, there are 18,500 companies as we speak. Every month we are adding around, I think 250 to 300 companies are getting added every month across the industry into the corporate NPS umbrella. So, you'll see that if your company is not there as a part of corporate NPS, just reach out to us and we'll be able to more than happy to help you. And I have a sales team which takes care of this as well. So, company needs to be a part of corporate NPS. Once the company is there, all you need to do is to talk to your HR folks. The POP, which is the point of presence of the distributor, is responsible for enrolling you onto NPS. You can actually open the account online. If you have a CKYC number, then the process takes less than 5 minutes. Even if you don't have a CKYC number, which will not be the case all of you will have a CKYC number because you're all active investors. Even if you don't have a CKYC number, the DigiLocker based Aadhaar identification is what is done, and the account gets opened within a matter of 5 minutes. Entirely end to end is digital, right? And you can do this. Just go on to any pension website. HDFC Pension website is, you can go through the HDFC Pension website, open an account, and then subsequently get it mapped to your corporate if need be. Otherwise, if your company is already on corporate NPS, then the point of presence that you're working with will be able to help you open the account. It's a very simple process.
Mr. Iyer, my last question, and I'm sure if anyone has a question, please write it on the chat box. But I think most of the questions as we were talking, we were trying to address. My question is for business owners. A lot of business owners, promoters, entrepreneurs are currently working. NPS as a solution, what do you feel how that could be used by them in the overall scheme of game? Yeah.
Excellent question. This is a question that I get asked many times when I'm, talking to, self-employed individuals. 2 points, right? Number one, irrespective of whether you're a self-employed person or a salaried person, uh, potentially you will have a salary structuring even if you're an owner. You may be a working director and therefore you may be drawing a salary from the company, right? This corporate NPS is applicable there as well, right? Point number two, outside of the tax benefits, and tax benefits are of course important and you should take advantage of tax benefits that are there. But hopefully, many of the features that we spoke about today, or many of the flexibilities that we spoke about today, one of them being automatic rebalancing, the other being the fact that you can change asset allocation multiple times in a year without any tax, without any cost. The fact that NPS can, on a standalone basis, be a very powerful retirement tool, right? On a standalone basis, you don't even need to do anything else beyond that. I think all of those things are equally important, irrespective of whether you're salaried or self-employed, right? Because this flexibility that the product offers and the fact that this is all happening at a fraction of the cost that actively managed funds charge you, I think, and that's one of the reasons why it is not very well known. We all know
Correct.
we all know the industry, right? I mean, that's the reason why people like me have to shout from rooftops to tell people that, come on, this is and having spent over 3 decades now in financial services, out of which 20 years in, doing financial products, hand on my heart, I can tell you, uh, this product has got the best of every financial product you pick up the best feature in every financial product and this product has it, right? And I think we need to do more as an industry to make sure that it is known to people. People are aware of this product. And that's one of the intents. That's one of the intents why I readily agreed to you and when you told me that, you want to do this session for
Okay.
your investors.
Sir, there is a one question which has come, PPF versus NPS. Can you throw some light on that?
Yeah, sure. See, PPF, nothing wrong. Every product, as I said, has a place in the portfolio. But I think you need to compare, in terms of what PPF does for you, what is the return profile there. If you were given a 15-year time horizon, what is the product choice that you should make? What is the flexibility? What is the visibility that you have on where the money is getting invested? I can talk about numerous things, but I think each different strokes for different folks. I'm not saying one is better than the other, but one of the things that I very strongly believe in is that if your time horizon is 10, 15, 20 years, then you are actually losing money by putting money in a fixed income product, right? Because very rarely will it beat inflation, the inflation that you and I face, not the inflation that the Sarkar publishes of 6% and 7%. That's not our inflation. Our inflation is 11, 12%. That's my belief, right? Because what we consume is inflating at 14, 15, 16%, right? So I think every product has a place in the portfolio. I'm not trying to diss any product, but all I'm saying is that long-term orientation, if it's there, then nothing, I mean, you need to look at market-linked products with a very strong flavor of equity so that you're able to take advantage of the fact that the time the risk in equity diminishes, right? I think that's something that we need to keep in mind.
Amazing. I think thank you so much, Mr. Iyer. I think I'm feeling that you can keep talking and talking because every word of yours is giving us so many new insights, which actually, practically, if you ask me, I personally have learned so many things from your session today. Thank you
Thank
so much. And again, as a concluding thing, let's reflect on why NPS deserves a place in your portfolio. Retirement planning in India is often being sidelined, but this offers a very strong solution, which is very efficient and built for a long-term haul.
That's
With Mr. Sriram Iyer's valuable insights, we have seen how NPS is more than a tax-saving tool. It's a gateway to a stress-free retirement, particularly for high net worth individual who need tailored solution aimed amid the lot of complex investment options available today. Thank you everyone for joining us today. Let's make simplicity, suitability, and long-term vision the pillar of our investment journey, and let NPS be our cornerstone for our financial freedom. Thank you so much all for joining us, and Mr. Iyer, thank you so much for your time. Thank you so much. And we have a feedback form running there. I request everyone to please fill that. Thank you. Thank you, Mr. Iyer.